Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden inside those massive corporate filings. And let me tell you, Restaurant Brands International, the company behind Burger King, Popeyes, Tim Hortons, and Firehouse Subs, it's just dropped its 2025 annual report, and it's a thick one full of number strategies and some pretty interesting risks. So buckle up because we're about to decode what it all means for the future of your favorite fast food joints. Before we dive in, if you like getting clear, actionable insights from these dense financial documents, make sure you hit that subscribe button and ring the notification bell so you don't miss out. Our Discord community is also linked in the description below. It's a great place to connect with other finance enthusiasts and get your questions answered. All right, let's get into it. Restaurant Brands International, or RBI as they're often called, is a global giant with over 33,000 restaurants in more than 120 countries and territories. And get this, more than 95% of those are franchised, meaning most of the restaurants you visit are actually owned by independent franchisees, whose success is pretty much RBI's success too, but they do own some restaurants directly, especially after acquiring Carroll's Restaurant Group in May 2024, a deal that brought a lot of Burger King locations under their direct control. At least for now, they plan to refranchise most of those pretty quickly. Let's look at the brand breakdown. As of the end of 2025, Tim Hortons has over 6,200 restaurants, mostly in the US and Canada. Burger King is their biggest powerhouse with nearly 20,000 restaurants globally. Popeyes is growing strong, with over 5,400 locations internationally, and Firehouse Subs has just under 1,500 restaurants. That global reach is huge, and the company highlights how they share best practices across these brands while keeping each one unique. Now for the main event, the financials. Their total revenue for 2025 was over $9.4 billion. That's a significant jump from 2024's $8.4 billion. What's driving that growth? Well, a big part of it is the domino effect from those Carroll's acquisitions. As they bought more restaurants directly, they also saw healthy growth in their supply chain sales, largely thanks to higher commodity prices and selling more packaged goods to retailers. But remember that foreign currency conversion, what they call FX impact, that actually took a bite out of their reported revenue growth a bit this year. Company restaurant sales, meaning the sales from the restaurants they actually own and operate, saw a massive jump up to $2.3 billion in 2025 compared to $1.5 billion in 2024. This is directly tied to those acquisitions like Carroll's. They are operating more restaurants themselves now, which means more direct revenue, but also more direct costs to manage. When we look at adjusted operating income, which is basically their measure of profit from core operations before some special items, it was $2.58 billion in 2025, up from $2.4 billion in 2024. This is a positive sign showing their underlying business is getting stronger, especially in their core franchisor segments like Tim Hortons and Burger King in the US and Canada. And internationally, they're seeing revenue growth and managed to keep their general and administrative expenses in check, which is always a good sign. Check out this chart here showing the breakdown of their revenue. The biggest chunk by far comes from their franchise and property revenues. That is the money they make from royalties and rent from their franchisees. This highlights their franchise-heavy model. Geographically, the United States is their biggest market, bringing in over $4.5 billion in revenue in 2025, followed by Canada at close to $3.9 billion. This makes sense given the strong presence of Tim Hortons in Canada and Burger King and Popeyes in the US. Now let's talk about the risks, because no corporate report is complete without them, and RBI is no exception. They are facing intense competition in the restaurant industry, which is pretty much a given, but they also highlight the challenges of evolving consumer preferences, like the growing demand for digital ordering and delivery, and if their digital platforms don't meet guest expectations, well, that could really hurt sales. They are also heavily influenced by economics. It conditions consumer spending is directly tied to things like unemployment and inflation, which can make people cut back on dining out. A major event this year was their deal with CPE Older Investment Limited regarding Burger King China. They effectively sold about 83% of Burger King China to CPE, forming a joint venture. RBI still owns a slice and has a seat on the board, but it signifies a shift. It also led to a significant cash charge of $114 million in their discontinued operations, a big move indicating they are reorganizing their international footprint. Speaking of discontinued operations, they reported a net loss of $126 million for the year related to BK China. This is a consequence of that joint venture deal and highlights the complexities of international expansion and divestment. Let's look at their debt situation as of the 31st of December 2025. They had over $13 billion in outstanding debt, Wow, that's a lot of money, and it means a significant portion of their cash flow goes towards paying off interest, and principal, this leverage could make them more vulnerable if economic conditions worsen. And what about their assets? Well, a huge chunk, over $11 billion, is in intangible assets. This primarily includes the value of their brands Tim Hortons, Burger King, Popeyes, and Firehouse Subs. These are their most valuable assets, and they regularly test them for impairment to make sure their carrying value on the books is still realistic. Goodwill, which represents the excess purchase price over fair value in acquisitions, is also substantial at over $6.3 billion. A big piece of that comes from the Carrols acquisition, which they are closely watching for potential impairment. If refranchising efforts don't pan out as expected, like they noted with the Carrols Burger King reporting units, fair value not being substantially in excess of its carrying value. Looking at their equity structure, you see Class A common units and partnership exchangeable units. The Class A units all belong to RBI, their parent company, and the exchangeable units are what trade on the Toronto Stock Exchange. The number of outstanding Class A units is significantly higher than the exchangeable units, showing RBI's controlling stake. The market value of these partnership exchangeable units held by non-affiliates was over $890 million on the 30th of June 2025. This gives you an idea of how much the public market values the portion of the company. Comparing their stock performance to the S&P/TSX Composite Index and a Consumer Discretionary Index, RBI has shown decent growth, though the journey hasn't been perfectly smooth. For example, while the Composite Index saw a strong rise from 2020 to 2025, RBI's performance, though positive, was a bit more varied. This highlights the ups and downs that can come with large global companies now. For my take on all this, RBI is clearly a powerhouse with iconic brands and a massive global reach. Their strategy of focusing on quality, service, and convenience delivered through a franchise model seems to be working, evidenced by revenue growth and improved operating income. However, the sheer amount of debt they carry is definitely something to keep an eye on, especially with potential economic headwinds and rising interest rates. The risks are real, and they are being very open about them, from intense competition to the complexities of international markets and the ever-present threat of cybersecurity incidents. The company is making strategic moves like the Burger King China JV and the Carrols acquisition. These are big bets that will shape their future, but also bring integration challenges and financial risks. The success of their refranchising plans for Carrols and finding partners for their international ventures will be key. Crucial opportunities lie in expanding their digital presence and new product innovation. But the biggest challenge will be navigating global economic uncertainties, consumer spending shifts, especially with inflation, and the ongoing impact of geopolitical events. Overall, RBI is a massive company with a solid foundation based on its strong brands and franchise relationships. They are navigating a complex business environment with both strategic acquisitions and divestitures and a clear focus on innovation. However, the debt load and inherent risks of a global franchise business mean that constant vigilance and smart execution will be key to their continued success. What do you think about RBI's latest report and their future prospects? Drop your thoughts in the comments below. If you found this breakdown helpful, please hit that like button. It really helps us out, and subscribe for more deep dives into the world of corporate finance. Don't forget to join our Discord community linked in the description. It's a fantastic place to continue the conversation and connect with fellow finance enthusiasts. Thanks for watching Corporate Decoder, and we'll see you in the next one.